Good morning, everyone.
Morning.
Sahil bhai, good morning.
Good morning. Good morning, everybody.
Shall we start the session? Meanwhile, the participants will join. Before formally starting the session, I'll request members to please stand for our ICA motto song.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्मिमाणः निर्मिमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्द्वैता 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 एतद्द्वैता
Very good morning to everyone. We are on a Sunday morning of a long weekend. We had a Holi festivals couple of days ago, and wish everyone a very happy Holi. Our today's session on capital market is a very quite interesting. 7 big lessons for the Indian investors and the effects of Russian-Ukraine war on our portfolio. CAS Sahil Chotalia will be taking our session. I request Ashish to please give an introduction of our today's speaker.
Good morning, everyone. Good morning, Sahil ji. A warm welcome to Untitled Study Circle. I'll give a brief about Sahil ji. Sahil Chotalia is a full-time investor and proprietor of Mount Bliss Capital, which is a SEBI-registered investment advisory firm. He manages the firm and is responsible for all the investment decisions here. He has more than 10 years of experience in financial services and has previously worked with Deloitte India as well as M3 Investments Private Limited. He is an avid follower of Warren Buffett and Charlie Munger and closely follows their principle on investing and capital allocation. He is a commerce graduate from esteemed Narsimhanji College of Commerce in Mumbai and is also a qualified chartered accountant. On behalf of the Untitled Study Circle, I welcome you once again, Sahil ji, and request you to take the session forward today. Your voice is not audible, Sahil ji.
It's still not audible.
Am I audible now?
Yes, perfect.
Is it good sound or not so good?
No,
sound?
good. Perfect.
Right?
Yes,
Great,
yes.
great. So I'll just share my screen.
Yes, please.
Is the screen visible to everybody?
Yes, it is.
Just a second. All right, great. Okay, first of all, a warm welcome to each and everyone joining the call today. Thank you for taking out this Sunday, and I hope I do justice to your time. So the purpose of this seminar, I want to cover 3-4 basic points. And the first is attention to the basics, right? The basics of investing.
Sahil ji, can you increase the voice?
Voice is not coming?
Yeah, it's not that good, which was the last time.
Just a second. Give me just a second. Now?
Yes, it is good. It is good.
It is good. Now? Better or not better than before?
I think the one you were using headphones earlier, that was a little better than this.
But actually headphones are not coming. I don't know why.
Okay.
No, but this is fine. This is fine.
Just let me try once. Headphones will work. Oh. What about now?
Yes, it is good.
It is good?
Yes.
Okay. So should I continue using the headphones or should I use
Now you can use the headphones.
I can use the headphones, right?
Yeah.
Okay. So the purpose of this seminar, I want to cover 3-4 points. First is I want to draw attention to the basics. Second, I want to share with you some tricks and tips to measure your performance. Then some elements that I will talk about to boost your wealth creation process. And lastly, we'll talk about some current affairs and their bearing on your stock portfolio. And let me assure you that this seminar is not going to be dry and boring. So I put a lot of interesting charts and live case studies to make it as interesting as possible. So let's dive in and learn the 7 big lessons for the Indian investor. Okay, so the first lesson that I want to share with you is equity is the best asset class. And there is no denying the fact that nothing beats the comforts and the returns that equity investing offers. So let's look at some of the alternatives that we have to equity investing. So what I've done here is I've created a table wherein I have put all the alternative investments that one has, and I have then categorized them basis of their return, risk, volatility, their tax implication, and the liquidity. Okay, so first we look at bank deposits, and bank deposits, the returns obviously are the lowest. The risk is also low. Volatility is not there. You have to pay full tax, and your liquidity is pretty high. Then government securities, you can say the same thing. Some securities may give tax exemptions, and your liquidity is also high to moderate. Then you have something called as bonds and debentures, where your return is a little better than bank deposits. Your risk is still low, volatility is also low, you have to pay full tax, and your liquidity is high to moderate. Then you have gold and commodities, where your return is moderate, your risk is also moderate, and your volatility can be high to moderate. Sometimes we see crude oil and all these things, they have a lot of volatility. So on that basis, we can say that sometimes the volatility can be high to moderate. Then you have to pay full capital gains tax on this, and your liquidity is also pretty high. Then the next is land and property. The return is moderate, the risk is low to moderate, your volatility is low, your taxes, you are paying capital gains tax on that, and then your liquidity again is very low. And then there is this problem of the whole cash thing. So there is a lot of friction when it comes to dealing in land and property. Then you have unlisted equity. Again, the returns are high to moderate, your risk is moderate, volatility is low because obviously it is not listed, and you have to pay capital gains tax, and your liquidity is extremely very low. And lastly, you have listed equity, where your return is high, your risk is moderate, volatility obviously can be high sometimes, and then you get this special capital gains at a lower rate, and then you have liquidity which is again very high. So you press a button and you can buy and sell shares. So I think if we have a appetite for volatility, then I think risk is something which I can show you in the coming slides, that how we can take a handle on risk. But if we have the ability to absorb volatility, then I think equity by far is the best equity asset. Now, if we compare the Nifty 50 with your spot gold in US dollars, and if you look at the last 25 years, okay, spot gold has given a return of almost 6.6%, whereas your Nifty 50 has in that same time period given a return of almost 13%. Again, if you look at the 20-year returns, your spot gold has given a return of 10%, whereas your Nifty has given a return of 15%. Again, if you look at the last 10 years, spot gold has only given a return of 1.6%, whereas Nifty has given a return of almost 14%. And if you look at the last 5 years, your spot gold has given a return of 10% and your Nifty has given a return of almost 16%. Obviously, these numbers are a little old. Markets have corrected a little bit from there. So a percentage or half a percentage point, maybe here or there, but you get the idea that equity wins in each time period. Secondly, the problem with commodity, I feel, is it's cycle based. So there is a lot of demand and supply factors that go in, and it is a global demand supply phenomena. So it's very difficult for any of us to kind of research and understand how commodities will behave. Not saying that you cannot do that, but that requires a lot of effort and a lot of experience to kind of master that. Secondly, Warren Buffett has a very interesting take on gold, which makes my wife very angry. Okay, so what Warren Buffett says on gold is he says that gold gets dug out of the ground in Africa or someplace, then we melt it down, dig another hole, bury it again, and pay people to stand around guarding it. It has no utility. Anybody watching from Mars would be scratching their head, right? And I'm not saying that investing in gold or property is bad. It is good. We need to have everything in our portfolio, but one must have a balanced portfolio of equity and all the other things that we have. Gold, inevitably, as Indians, we have to buy because in marriages and all, gold given as a gift in any community in India, right? So we Indians, we love gold. So gold, inevitably, everybody gets. And I think property also, we have this fascination that whenever somebody makes money, the first investment he'll make is buy a house or buy a property and put it on rent. So that is something which is culturally there within us. But one should look beyond these asset classes. So what is the ideal asset allocation? And according to me, at least 30% of your patient's capital should be in equity related assets. Now, what do I mean by patient's capital? So patient's capital is basically your total assets or your total wealth. And then you remove your house or the houses that you live in. Okay, you may have a joint family, you have more houses, but whatever house you have, you remove that. Then any assets that are tied to your business, your working capital or any office property that you own, you remove all of that. Then you remove the gold that we have in the house that is owned by our wives and mothers. You remove all of that. And then any amount that you have committed towards your children's educations or your daughter's marriages or anything like that. So any committed funds that are there to a specific purpose, or somebody may be saving to buy a house, you remove all that committed funds that are there. And then you remove, say, 1 to 3 years of your living expenses, what we call as emergency expenses or emergency medical expenses, whatever you are comfortable with, right? You remove that. And whatever then is left is basically your patient's capital. So of that patient's capital, at least 30% should be part of equity. Now, why am I insistent on why 30% should be in equity is because you have to participate or you want to participate in the India growth story. Now, what is the India growth story? So currently we are at almost 2.6 to 3, between 2.6 and $3 trillion economy. And we have done this or achieved this in the last 75 years since our independence. And Moody says that by 2026, India will become a $5 trillion economy. And by 2031, we will become an $8 trillion economy. So obviously these numbers are all forecasts, but even if these forecasts don't play out exactly, but what most people believe or most economists believe is that India is really going to grow a lot more in the next 1 or 2 decades than it has grown in the last 75 years. So we are looking at massive growth of the Indian economy. And when you look at economies like the US economy, which has really grown in leaps and bounds after the Second World War, and what growth we have seen in China in the last 2 decades, it is mind-boggling. And the only thing that will fall short is our imaginations. India is going to grow so much. So I'm very bullish on the Indian growth numbers, and I think everybody should get a chance to participate in this growth story. So this was the first lesson, that equity is the best asset class and everybody should have at least some amount, a good amount tied to equity related assets. Now, the second lesson that I want to share with you is index investing is hard to beat. So for those of you who don't know what an index is, quickly, I will just tell you what an index is. So index is basically a basket of companies from the various sectors of the economy. So we have two broad-based indexes in the country. One is the Sensex, which is a basket of 30 companies. And then there is something called as Nifty 50, which is a basket of 50 companies. So these 50 companies are from various sectors in the economy, and they kind of represent the entire Indian businesses or Indian economy. And then you may have something like a very specific index. Say you may have a Nifty mid cap, or you may have a Nifty pharma, or a Nifty finance, or Nifty bank, wherein only companies from the banking sector are there, or companies from the IT sector are there. So then you have specific indexes. But what we are particularly talking about is the broad-based index, that is the Sensex and the Nifty. So let me just share with you my story of how I got into investing and what was my first experience doing investing. So I was working with Deloitte, I think around 2008. And then at that time, we paid a handsome stipend in Deloitte, and we used to save some money every month. And then, Indian families, generally, we have this tendency of saving. So then I got that pretty early in life that, okay, we have to save some money. So every month I used to save 7,000 rupees after all my expenses. And I started putting this money in equity. And in that 3-year period, I saved close to 2 lakh rupees. Okay. And I invested in the market. And this was done by everybody. My colleagues, my bosses, my partner, everybody was doing some sort of investing. And in that 3-year period from 2008, that 2 lakhs had become 50,000. Now, if you look at this period of 2008 and 9, this was a period where the markets hit the bottom, right? So if anybody would have invested in any decent company here, the growth was massive. But despite this growth, I actually lost 75% of my wealth, right? So this is a little strange, but
Sir, please excuse. Your voice is actually not clear to many members.
Okay.
Because
we'll do something. Just give me 1 second. I'll
yeah, sure. Sorry to interrupt.
No issues. Hello. Is this nice? Hello.
Ashish?
It is okay, but not the same while we were interacting in the initial session.
Okay. Just a second. Okay, is this better now?
Still the same, actually.
Still the same? Just a second. I'll just change some settings from here. 1 second. I think I got it. I got this. 1 second. What about now?
Still the same.
What about now?
No.
No?
No.
Nothing. This is better now? No?
No, I mean it is same while we were doing earlier, but not the initial voice level.
Okay. Hello. Now? What about now?
I think you can log out once if convenient to you, and then log in again through.
Okay. What about now?
Still the same, sir.
Still the same thing, right? So I'll do that, right? We'll just.
Yeah, that may help.
Okay. Or we can 1 second. 1 second. What about now? Better now?
No, still the same.
Still the same?
Yes.
What about now?
Little better. Little.
Yeah, I think this is what I was using before. Is this better now? No?
No, it was way better earlier. But then just try once logging out and log in again, or else we can continue on this. No issues.
Okay, chalo, we'll do that. I'll just log out once and then join again.
Sure.
Okay? Yeah. Hello. This sound is okay. Hello.
This is very much better. Very much better.
Hello.
Sahil bhai, this is much better.
Much better, no? So okay, what I'll do is I'll speak. You'll get my voice from this machine, and I'll present from the original machine. Is that okay?
Yeah, that works. That works.
That works, no? Chalo, great. Chalo, we'll do that. Okay.
But I can't see your name here.
No, I'll join. Wait,
Okay.
I'll join.
To all the participants, sorry for the inconvenience.
Okay, is this better now?
Yes, this is perfect, Sahilji.
This is perfect. Okay, should I go back a little bit or should I continue from here?
You may continue. I think no, should not be an issue.
Should not be
Any participants, if they wish to hear what the speaker said in the past 10 minutes, just
I can quickly do a.
You can revise for the next 5 minutes.
Yes, yes, you can revise for a couple of 5-10 minutes.
Okay, chalo, great. Okay, so hi again, a warm welcome. I'm so sorry for the inconvenience before. I hope I'm audible now. Okay, so again, just to quickly rush up. First of all, thank you all for coming. 4 purposes for this seminar. First is to bring attention to basics, some tricks and tips to measure performance. Then I'll share some elements how you can boost your wealth creation process. And then lastly, we'll discuss about the current affairs and their bearing on your stock portfolio. And the first lesson that I want to give is equity is the best asset class. And nothing beats the comforts and returns that equity investing offers. And let's look at some alternatives that we have to equity. And if you look at the chart or the table here, we have bank deposits, we have government securities, we have bonds and debentures. And if you see in the whole of this thing, okay, equity has the highest volatility, but it also has the highest return. Okay. And I'll talk a little bit about how we can take a handle on risk. And once you have the handle on risk, equity investing actually becomes extremely efficient as an investment tool because you are paying lower taxes. There is the highest liquidity that is there in listed equities. So you push a button and you can buy and sell shares. So very frictionless, very easy, lower taxes, highest return, and just a handle on risk, and equity becomes the best asset class. So then we discuss this chart as to how Nifty 50 and gold has done in the past. If you look at the last 25 years, so in the last 25 years, spot gold has done 7%, Nifty has done 13%. In the last 20 years, spot gold has done 10% and Nifty has done almost 15%. In the last 10 years, spot gold has done 1.6 and Nifty has done 14. And in the last 5 years, 10 and 16. So you can see from here that Nifty 50 has done better than gold in all the years any year that we look at. The other problem with commodities that I feel is that it is cycle based. So there is a lot of demand and supply that makes the price of a commodity, and that is a global demand and supply. So it's very difficult to kind of forecast what is happening on that front, and any world changing event has a big bearing on commodity prices. So obviously people are able to do that, but obviously it takes a lot of effort to kind of understand how commodities behave and to meaningfully invest and make some money out of that. And Warren Buffett has a very interesting take on gold, which makes my wife very angry. And Warren Buffett says that gold gets dug out of the ground in Africa or someplace, then we melt it down, dig another hole, bury it again, and pay people to stand around guarding it. It has no utility. Anyone watching from Mars would be scratching their head. So I'm not saying that gold and investing is bad. Obviously, gold and investing is good. And culturally, gold is bought a lot in Indian families as it is, right? So I'm not saying gold or property is bad, but I'm saying that one should have a balanced portfolio. And what I believe is that at least 30% of all your patient's capital should be part of equity, or should be part of equity assets. So what do I mean by patient's capital? So patient's capital is basically you take your total assets and you remove your house, all the assets that are tied to your business, any gold that your wife or your mother owns, and then any committed funds that you have towards your children's education, or buying a house, or getting your daughter married. You remove all those funds that you are saving for a specific committed purpose, and then you remove emergency funds of say 1 to 3 years of your expenses, whatever you feel comfortable. You remove those as emergency funds, and whatever then you are left with is basically your patient's capital. And 30% of this patient's capital should be part of your equity. Now, equity helps you to participate in the India growth story. And like I said before, currently the Indian economy is somewhere around $3 trillion. And as per Moody's, by 2026, we should become a $5 trillion economy. And by 2031, we may become an $8 trillion economy. So what we have done in the last 75 years since independence, we are going to do that much and more in the next decade or two. So if you look at economies like the USA, which is now basically a $20 trillion economy, and what they have done after the Second World War, and if you look at China, China is again a $15-16 trillion economy, and what they have done in the last 2 decades, it is mind-boggling, right? So that kind of growth we can expect in India, and I think the only thing that will fall short is our imagination. So if one can consistently keep investing in equity, we will inevitably get the benefits of the India growth story. So the second lesson that I want to give today is that index investing is hard to beat. Now, what is index investing? So index investing is basically a basket of companies from the various sectors of the economy. And we have 2 broad-based indexes in India. One is the Sensex, which has a basket of 30 companies, and one is Nifty 50, which is a basket of 50 companies. And what basically happens is that in an index, you have the opportunity to invest in the entire economy. So index investing, why is it hard to beat? So I will just show you or share with you one of my first experiences with investing. So my first investing experience happened when I was doing my articleship with Deloitte. And that was a time period when I used to save some money doing articleship. And after that, saving that money for 3 years, I saved close to rupees 2 lakhs.
You are on mute. Sahil, you are on mute.
Hello?
Yes, audible now.
Yes, continue.
Yeah, sorry. I think how long back did I go mute?
Just for a second or two, not much.
Okay. So this was a period when I had invested 2 lakhs in the market, and in that 3 years, that 2 lakhs had become 50,000, right? And this was a period where the markets were at the bottom, and anybody you would have invested in this period, then the market really grew from there. So why such odd results? When the market was growing so much, then why did I end up losing so much money? So this is a period when you are too young and you don't understand things, and you are influenced by your colleagues and what they are doing. And then I used to go in the office and ask everybody what I should invest in. And a lot of people told me a lot of things. And one stock that I purchased at that time, I remember, it was called Ackman Offshore Limited. And this was a guy called Ramchandra who was there in BPL Mobile. We used to do the auto BPL Mobile. and very senior guy, and full day he used to sit on his computer and talk about stocks and do this trading, buy and sell. So he showed me this graph at that time. Okay. So you see the stock had gone up in almost around 2007-8, it had gone above 5,000 rupees. Okay. And then it came crashing down. And then the stock was at around 1,200 rupees, when I invested somewhere here, the yellow dot that you see. Right. And the story was simple that, see, this stock has gone up to 5,000, it's come down so much, and now it's going up again, and now it will again reach 5,000. Right. So the idea is simple, you invest now, you will make so much money. And then I said, okay, fine, let's buy some stocks. And I bought some stocks at 1,200 rupees. And then the stock immediately, after some few days and months, it went to 1,600 rupees. So I added a little more. And then this red dot that you see, that is when one of the rigs. So basically, this was a company that was buying rigs or manufacturing rigs, and then it was giving it on rent to other oil exploring companies. So what happened is that one of the rigs that they had actually sank, and when the rig sank, they ended up losing a lot of money. So from the price of 48 rupees, from the price of 5,389, a lifetime high of almost to 20,000 market cap, the current price is almost 48 rupees and somewhere around 300 crores of market cap. So you can see the wealth destruction that has kind of happened in this stock. Now, interestingly, I found an article much later in 2010, and the article talks about how one of the rig got sunk and then they lost 11% of their revenue. Okay, and which will severely impact their debt payment. And at that point in time, they had an estimated debt of around 11,000 crores. So you can only imagine that a company which has such high debt and such high interest payments, and then one of the ships, if it sinks, then that is going to be a problem on the company. So my portfolio at that time had such great stocks only, and that is why my wealth got depleted by almost 75%. Now, in that same time period, if I would have invested in the Nifty 50, right, I would have made 6x money. So that 2 lakh rupees today would have been around 12 lakh rupees, right? So I will just like to show you why index investing is so simple, right? So say if somebody has a 12,000 rupee investment every month, an SIP of 12,000 rupees, and say the expected return is say 12%, and on the other hand, if you invest in an FD, it is 7%, and say your investment duration is 30 years, right? So the total amount that you would invest is 43 lakh rupees in both the cases, but your total retirement corpus would in one case be 4 crores, and in the other case it would be 1.5 crores. So you can see how big a difference just a few percentage points makes. So if somebody is investing in fixed deposit and earning 7% and does that for 30 years, he will only have 1.5 crores. Whereas on the other hand, somebody investing that same money in an index fund, making only 12%, will have almost 4.5 crores. So just by adding 5 percentage points to your returns, the end result becomes very different. Now, in this same example, if say somebody invests 50,000 rupees a month, say if a young chartered accountant invests 50,000, or a person who is in the 30s or mid 30s, he can easily invest 50,000 rupees every month. If he invests 50,000 every month, and if say the expected annualized return is 12%, and he does that, then in his whole lifetime he would have saved around 2 crore rupees, and that 2 crore rupees would have become almost 17 or 18 crore rupees, right? But if you would have earned 15% on that, okay, then the amount becomes very big. Then it is almost 35 crore rupees. So you can only imagine what percentage returns investment does to your total returns, right? So there is a cartoon that is actually making fun of all the adventure seekers like me. Okay, so this is a guy, he's market, but we got to spend time learning about obscure companies and industries no one had ever heard of, instead of just sitting by the pool with index fund holders sipping margaritas. So you can only imagine that the only thing that you then remain to say is all these stories that are there, right?
Manish bhai, Sahil bhai, your voice is on mute again. Sahil bhai, we can't hear you.
No, I think he has logged out mistakenly.
Hello, am I audible? Hello.
Yes, you are audible now.
Okay. Had I become audible, unaudible before?
Yes, for some time.
Or just for some time? Okay. Just a second. Huh? Is my screen visible?
No.
Now?
Yes, it is.
Okay. So should I start from the previous slide?
No, from this current slide.
Okay.
Yes.
So indexing reduces decision making considerably. Number one. Number two, it is the lowest cost of investing. So any index fund that you buy is going to be the lowest cost in mutual fund, PMS, whatever you buy. Any professionally given service, index fund is the lowest cost out there. So there is lowest risk within equity, obviously, because you are buying the best of the companies in India, and within that also the exchanges will from time and again keep churning out bad companies and adding better companies. Best for passive investors, people who are doing their business or profession. It's best for them. They don't have to get involved at all in that process. And then it is available in various themes. So I know many people who feel that pharma is becoming cheap, right? So what they will do is they will go and instead of buying Sun Pharma or any one particular pharma company, they will go and buy the pharma index. So they will get benefited from that also. Similarly, you have these themes that are available, which are sector based or country based or market cap based. Like now China also, many people are investing. There are many people who think that China has become really cheap, and if you want to participate, then there are many funds available in India which follow the Chinese indexes. And then it is recommended by Warren Buffett. So this is a quote by Warren Buffett, and Warren Buffett says a low-cost index fund is the most sensible equity investment for the great majority of investors. My mentor Benjamin Graham took this position many years ago, and everything I have seen since convinces me of its truth. So there is a guy called John Bogle, and he's the first guy who started a company called Vanguard Investments, and they were the first people who actually gave index funds, so to say. And Warren Buffett always talks about him, and he says that index investing for a person who doesn't know anything about investing is the best thing to do, and it will give you better returns than any other asset class with a minimal amount of risk. Now, this is about, till now what we spoke is, first we have to invest in equity, and second, the easiest way to do it is to buy an index fund. But suppose if somebody wants to is not happy with this 12-15% return that an index offers, and somebody wants to beat the index, then what do you do if you want to beat the index, right? So say if I tell you that if you make 26% CAGR, then you make 10x in 10 years. So that is why Albert Einstein tells compounding is the 8th wonder of the world. Now, how does this CAGR thing actually work, right? So what is CAGR? So look at this chart and you will understand. Let's say if I'm on year 1, my starting amount is 100 rupees, and if my return is 26%, then the ending amount will be 126. Similarly, second year, my starting amount will be 126, and so on and so forth. And if you do this calculation for 10 years, then in the 10th year, you will have 1,009 rupees. So basically, your 100 rupees become 1,000 rupees. So 26% CAGR is 10x in 10 years, right? Now, let me give you an example. Okay, so say you have purchased a commercial property in January of 2017 for say 1 crore, and the price of this property in December of 2021 is 2 crores. Then what is your CAGR on this investment, right? So if somebody wants to calculate this, so you have the property for 5 years, your beginning value is 1 crore, your ending value is 2 crores, then what is the CAGR on this investment? So we have this formula for CAGR, which is your ending value divided by the beginning value, the whole raised to 1 by n minus 1. So if you apply this formula on the given problem, then you get a CAGR return of almost 14.87%, correct? Now, if one has to evaluate all your returns, I think CAGR calculation is very important, right? So when you're talking with a friend or a family member and you're discussing investments, always try and talk about investments from a point of view of CAGR return kitna bana. And once you can bring all your investments under the CAGR return, then all investments kind of become comparable, correct? So the easiest way to do is you can have these mobile apps. You get a lot of mobile apps. You just put in the initial value, say 1 crore, the final value is 2 crores, and say the number of years is 5 years. Then it will show you the CAGR, right? So then it becomes very easy for you to actually calculate how much returns you have made, right? So you can find a lot of calculators, and one calculator that I use is by Purok Santoke. Okay, this is a very simple app without any ads and all. So you all can download this on your phone and use this. Now, say if I have to make this problem a little more realistic, right? And say in the same example, we take the purchase value as say 1 crore, okay? And every year, say you are getting 6 lakh rupees as rental. So say on the 1st of January, the day you purchase the property, somebody gave you 6 lakhs to use the property for the entire year, for simplicity of calculation, okay? Maybe this can be monthly. Then on the 1st of January 2018, you got 6 lakhs. Then say on the 1st of July, you had to do some repairs and maintenance. So you put minus 5 lakhs, so on and so forth. And then your closing value is 2 crores. If I want to calculate the return of this particular problem, then how do I do it? Then I will have to use an Excel formula for this, which is an XIRR formula. Okay, and what I simply do is I take the XIRR formula, I put all my cash outflows as a negative value, I put all my cash inflows as a positive value. I just have to do that with the dates. And then you just run this formula, you select the amount range and the date range, and it will give you a return of almost 19.46%, right? So I think this is an exercise which every investor should do, especially people who are buying stocks, right? So for stocks, the same thing will be, as and when you have purchased the stock, you will put that as a negative value. As in when you have sold it, you put it as a positive value. Whatever dividends you have got, you put it as a positive value. And whatever your closing balance is, you put it as a positive value. And then you run an XIRR on this. So what it does, it gives you a return basis the time, right? So I know many people who come and tell me that, I have made so much return. But when they actually do this date-wise, then they realize that the returns are actually not so much. The returns are even worse than the FD returns. So then there is no point investing. So what I believe is that anything that can be measured can be managed. If you cannot measure something, you cannot manage it. So I think the one lesson that everybody should take from here is, first of all, start talking about returns in CAGR numbers, and whatever investments that you all have made in the past, filter those investments through this XIRR formula, and then see what actual returns you all are kind of making. Right? Then the second thing that I want to talk about is the advantages of starting early. So say if somebody would have to start at 23 years of age, okay, and somebody wants 55 crore rupees at the age of 60 years, then the investment period is almost 37 years, right? So you start at 23, you have 37 years of investing, and you want 5 crores when you retire. So you would need to save or put in an SIP 6,100 rupees every month. Say if that same person is starting at 35 years of age, so his investment period becomes now 25 years, and now again if he wants 5 crores, then the SIP amount becomes 26,600. So you can only imagine the advantages of starting early. So when you start early, even small amounts saved over a very long period of time will generate a lot of wealth. So one example I can give you here is Warren Buffett has compounded his wealth at 22% CAGR over 70 years. And Jim Simons, who is a hedge fund manager of Renaissance Technologies, he has compounded his money at 66%. Okay, so imagine 22% and imagine 66%. And this he has done only since 1988. And he is 75% less rich than Buffett. So starting early has an advantage, even if somebody is getting a return, a very high return, if the time period is less, and if you have a lower return and your time period is more, still you will end up making a lot more money. So what are the options if you want to beat the index? What are the options that are available to the Indian investor? The first option we have is an actively managed mutual fund. Okay. The second is that we can go to a portfolio management service. Now the problem with the portfolio management service is that minimum investment you need to give them is 50 lakh rupees. Anybody who doesn't have 50 lakh rupees cannot become a PMS client, right? The third is you can go to a registered investment advisor. Obviously, there are no restrictions on the advisors. You can give them any amount of money. But in PMS, they will offer you custodianship also. So they will manage the buying and selling or the execution also. In RIA, the execution they will not be able to manage. Execution will have to be managed by you. Then you have something called as an alternate investment fund, where the minimum amount that you need to invest is anywhere between 25 lakhs to 1 crore, depending on what kind of AIF you are investing in. And the minimum tenure is 3 years. And AIFs are generally closed-ended. So after some point in time, say 5, 8, 10 years, the AIF will shut, sell the assets and give you your money back. Then you have to again find a new investment opportunity. And the last option is DIY, that is do it yourself. So there are many people who are very successful at this also. They do their own research, they understand, and then they will invest. Now say in the previous example of that 2 lakh rupees that I burnt, if I would have just bought Titan for that money, how much return would I have made? So in Titan, from 2009 till today, my return would have been 39% CAGR, which is almost 52 times. So that 2 lakhs would have become 1 crore 4 lakhs today, right? So that is a lot of money. Again, if I would have invested in a company like Asian Paints, my return would have been 34-35% CAGR, and I would have made 36 times return. So my 2 lakhs would have become almost 72 lakh rupees, right? So that is again a lot of money. So then somebody in one of the seminars that I conducted earlier, they said, sir, but you bought it at the bottom. Not necessarily that we will get everything at the bottom only, right? So even in that, if you say you pay 100% of what Asian Paints said, Asian Paints was at 89 rupees, say you pay double the money, still you would have made 18 times the return. And similarly with Titan, if you pay, it was for 47 rupees, if you would have paid 94 rupees, still you would have made 26 times returns, which is again not bad, which is a CAGR of almost 31%. Who makes 31% CAGR, right? So again, the money that you would have made would be phenomenal. In Asian Paints also, you would have made almost 27% CAGR. So you would have made 10x your money. So, generally there is this misconception that high risk is equal to high return and low risk is equal to low return. So I think that is not the case. Sometimes it can be the other way around also. So the lesson we learn from this is that there are three things or three ingredients that make up wealth. First is savings, second is time, and third is the CAGR returns that you make. So to get more savings, one has to delay gratification. So how do you delay gratification, or how do you save more money? So one story that I can tell you is my grandfather used to tell me this story. And what my grandfather said is that when he was young, he was an orphan. And in the day, he used to work some jobs, some odd jobs. And in the night time, sometimes, there was this gang that used to operate in his village that used to smuggle jaggery, wood ka smuggling hota tha tab. So my dada would sit, he was a child, and he used to sit at that bullock cart. And the bullock cart, he would run the bullock cart, and then he had a full cart full of gold behind, full of jaggery behind him. And then my Dadaji used to have some sing chana in his pocket, and then he would mix it with this jaggery and he would eat it. But if you take the jaggery from that cart, then the people, the smugglers who were there with you, they would back you, right? So you can't do that. So when in the night, when everybody is like a little tired and all, that time when nobody is watching, he would take a little jaggery and then he would mix it and he would eat it. And so he used to always tell me that your wealth is also like that good, in your cart. So one should only consume the way one would consume at that time. मतलब वो जैसे चोरी करके खाते थे, वैसे आपको चोरी करके खाना है अपना ही खुद का पैसा. And that is the way you can create a lot of wealth. And that is what I call delayed gratification. So anything that you can delay, you should delay, and you should try that money goes towards savings. So that is one way of increasing savings. The second way to increase savings is to save money. So sometimes there are these expenses that we do which are not needed, or which you can do without. So my dad always says money saved is money earned. So one can even do that and try and save more money. More you save can then go towards your savings. The second is time, and for time one has to start early. So the young people who are there in this seminar today, start early so that you get more time. And the third is CAGR. And CAGR, for getting more CAGR, you have to invest in quality companies, right? So we will talk about this as we move ahead. So the idea basically is to find the next Titan or the next Asian Paints. And to do this, you require a sound investment philosophy, right? So the fourth lesson is what makes a sound investment philosophy. So let's review some philosophies that are there around the world, how people have made money in equity per se, right? So the first name that comes is Warren Buffett. So Warren Buffett is known as the Oracle of Omaha, and he's by far the greatest investor in the world. Now, why is he the greatest investor in the world? So the current net worth of Warren Buffett is almost $113 billion, right? And he has given an equal amount of money to charity, right? So if he would have not given that amount to charity, then he would have close to more than $200 billion today, which is equivalent to what Elon Musk has today. So if he would have not given that money to charity, he would have been the richest man in the world today. So his funda is very simple. He's a very disciplined guy. He thinks very long term, buys only good quality companies, and then he just sits and waits. And he's undefeated at 91 years of age. So he's got that long investment horizon. So when I look at Warren Buffett, I feel like I have to live longer also. So I try and do more healthy things to live longer and try and be happy all the time, right? So that is one investment approach that is there. And the second investment approach, that there's a famous guy called Bill Ackman, and Bill Ackman is basically an activist investor. So what he does is basically he will corner shares of large corporations, and then he will kind of become the major voting in that company, and then he would corner the management and tell them to take certain decisions. Now the problem with this kind of investing is sometimes if things go right, they can go very right. But with Bill Ackman's case, he has gone wrong many a times doing this. Then afterwards, he started shorting shares of certain companies, and then he would go out in the media and say negative things about the company and I hope that the stock prices would correct. And one such company that he shorted was called Herbalife, which makes some nutritional supplements. And that whole shorting went horribly wrong, and then he ended up losing almost $450 billion doing that, right? Then he's made some money now betting against or betting that the corona recovery will be faster, and then he's again made a lot of money doing that. So he basically does very radical things, not very simple things, but that's how he has made his money, by doing very, very radical things. Then the third person we talk about is Cathie Wood. So Cathie Wood built an AUM of almost $50 billion, and she runs a mutual fund called ARC Innovation Fund. And she started when she was 54 years of age, right? And she only invests in 5 themes. So she invests in DNA sequencing, energy storage, robotics, AI, and blockchain. So all new age businesses she invests in, and her most successful investment has been Tesla, right? And before 2021 started, she was actually doing a return of almost about 39%. And in 2022, now everything has kind of corrected. All the tech stocks have corrected, and still she has done 20% CAGR, right? So we don't know whether she will succeed or how much she will succeed doing only tech, but this is also one way to make money. Then there is a guy called George Soros, very famous investor. He basically does trading. So he takes massive directional short-term bets on currency, stocks, and bonds. And since 1973, he's done 30% returns every single year. Okay, he's never made a loss in the last 30 years or 50 years, right? So phenomenal guy again. Then there is a guy called Jim Simons, which we spoke earlier, and he runs a quant fund. So there is this all algo trading that they do, and they have certain formulas that they have built over the years. And he only employs people who are mathematicians, physicists, statisticians, and they have kind of made some computer-based formulas on which they mix certain trades, and they earn a lot of money. And his return has been 66% CAGR so far, which is the highest that is there in human history. Jim Simons has done better than any investor out there. Then there is a guy called, 2 guys called Nick and Zach. They ran a fund called Nomad Fund, okay, in Nomad Investment Partnership. This is a UK-based fund, and they started in 2001 and they shut it down in 2014. Now, why they have to shut it down? Because they were invested only in 4 stocks. So they started with a lot of stocks when they started. They had almost 15, 20, 25 stocks in their portfolio when they started, and they invested in companies, cement companies in Zimbabwe and things like that. And by the time they ended, they evolved their process so much that they were holding only 3 or 4 stocks. And these 3-4 stocks, one was Berkshire Hathaway, that was Warren Buffett's company. Then they had one Amazon, which they had more than 50% in Amazon alone. And they had one company called Costco, which is Charlie Munger, Warren Buffett's partner's favorite company, which is something like a DMart of the United States, right? So this is also one way to invest. So they say that we want to hold a very concentrated portfolio and we want to do only high quality things. And they have also made close to 20% CAGR returns so far, and they continue to hold all of those investments in their personal capacity. I think Zach almost has 70% of his investments only in Amazon. So people have such concentrated portfolios also. So these are a few examples I wanted to give as to how different people have made money doing different things. Now, I want to talk a little bit about the family office that I work for. So there is a company called M3 Investments that I work for, and this is basically a fund. So the company was owned by just one family, and whatever money was there was only of that family. And there were 5-6 analysts who used to work only for that fund and only for that family. Now, what happens in the family office? So first of all, they have an investment model. So they have these set rules for investment selection. And any HNI today in India or ultra high net worth individual in India today, be it the Tatas, the Birlas, or anybody you name, they all have family offices. And then they have divisions within the family office, and certain fund is allocated and a certain model is given. So one will only invest in startups, one will only invest in blue chip stocks, and so on and so forth. Right? Then this is run by experienced professionals, analysts, fund managers are there. Right? Then third is that they are goal oriented. They have well defined return objectives. Right? So your return objectives are, they want to make 15%, they want to make 25%, they want to make 50%. And then basis on that return objective, they will then select whatever investment opportunities come their way. Then there is a lot of research intensity. Everything is well documented. There is thesis, there is outcome, there is learning, and all this keeps happening on a regular basis. Then there's a network of like-minded investors to bounce off ideas. So whenever, in an investment circle, even for me today, I have a few people, 5-7 people who are like-minded to me, and we would keep networking within ourselves to bounce off ideas. And the last point is, it is sustainable. So even if the promoter doesn't want to get involved, or the promoter generations don't want to get involved, then this process can be institutionalized. You can get the right people, and then future generations can take the benefit without actually getting involved in the business. And this is what Warren Buffett has also tried and done. So after Warren Buffett goes, he has selected the right kind of people who already are running the fund and who will take it forward. And then maybe 50, 100, 200 years out, Berkshire Hathaway will keep functioning and keep evolving, and shareholders can keep benefiting. So it is sustainable. So what I've seen with a lot of people is that somebody in the family is doing equity, and then person dies, and then people don't know what to do with those shares, right? And then they will either sell off those shares, or they don't know what to do with it, right? So that problem doesn't happen with a family office. The family office will take that investment forward. So what is my investment philosophy? So my investment philosophy is very simple. My investment philosophy is invest in the best companies that belong in the best industries and that are available at fair valuations, right? Now I'd like to just touch upon each of these ideas and explain them in detail. So first, let's talk about what makes a company great, right? And these are all the ingredients that you need for a great company to invest in. So first point that we see is great industry economics. Okay, so let's look what makes an industry great. Okay, so you want to invest in a company or in an industry which has low capex, which has low opex. So low capex is low capital expenditure, low opex is low operating expenditure. There should be no government regulation. It should be secular nature of product or service. So it should not be a cyclical industry. It should be a secular industry. So your growth should keep coming every year. Then it should have a high ROE. There should be huge size of opportunity, and there should be high growth. So sometimes we see that there are good companies, but the opportunity size is only very small. So that's 100, 200 crore or 500 crore opportunity. You may talk about a niche chemical or a niche pharma company which is making, say, vaccines for some animals or something, but the entire opportunity is only 200-300 crores. So we don't want such companies. We want companies which have huge size of opportunity, right? So we should be able to cater to the mass people, and then within that industry, the growth should be high. So let's look at some examples of good companies, okay, or good industries. Okay, so you look at the paint industry. So you look at all the companies in the paint industry, they are all trading at almost 30, 50, 100 P, right? If you look at their price to sales, Asian Paints almost at 10 times sales, 7 times sales. So they all do good price to sales also, right? If you look at their debt to equity, their debt to equity is also not so much, 0.11, 0.32, which is decent. And if you look at the ROE is also decent for almost all the companies. So they are all doing more than 20% ROE for most of the companies. And their cash cycle or their inventory, debtors and creditors, if you add and subtract all of that, then they are turning their money back again into money in 59 days, 79 days, 100 days. So overall, it looks good. And because of this, paint companies do get better valuations, right? Similarly, if you look at MNC Pharma, again, MNC Pharma, you look at the ROEs, again, ROEs are very healthy, almost 31, 30, 25, 20, very healthy ROEs. If you look at the sales growth is also great for at least 2-3 companies. If you look at the price to sales, again, price to sales is very expensive. So almost 7 times se to kam kuch milta hi nahi, right? And if you look at the cash cycle, again, it's very healthy, right? That almost not there, right? So you see that their operating profit margins are also very healthy, almost 20, 21, 25%. So basically, these are good industries. They grow well. They make a lot of ROE, and so they are valued accordingly. Then let's look at some of the bad companies that are there. So if you look at the auto commercial vehicles per se, okay, it's a cyclical kind of a business, okay. And if you look at the sales growth for the past 5 years, it's all negative, right? So they are negatively growing since the last 5 years. If you look at the PAT, so Tata Motors does almost 3 lakh crores of sales, but it is 20,000 in losses, right? If you look at the ROE, again, the ROE for the companies that are ROE positive, it's 15%, 5%, -3%, -11%. And they have these huge debts, debt to equity ratios, almost 3.3 times, 3 times. So it's very bad. And the operating profit margin is almost 10%, right? Compared to the paint and pharma, this is very low. Cash cycle is okay, good. So overall, you see that these businesses then don't get valued accordingly. So if you look at the price to sales, then they don't get the price to sales. They are all under 1-time sales, right? So because of the debt, because of the low ROE, because of the low operating profit margin, these are not good companies to invest in. And if you see in the last so many years, these companies have not given that kind of good returns, or the returns are very volatile. So when the cycle is going up, that time investors will make money. When the cycle then turns around, then investors will lose money. So if you want to invest in these companies, then you have to invest in the down cycle, wait for the cycle to turn up, exit in the up cycle, and then again wait for the down cycle to come. So this is how typically one would invest. But then again, you have to keep making those decisions. Whereas if you invest in the pharma or the paint, then you buy once at a good price, and then you can hold their stocks for very long periods of time. Similarly, if you look at the hotel industry, okay, again, very pathetic industry. You see price to sales optically looks good now. But if you look at the PAT, everybody is negative. ROE is almost non-existent. Debt to equity is also pretty high. And overall, not good, right? And PE cannot be calculated because there is no earnings only, right? So again, not the greatest of the great investments. And then you look at telecom, the worst of the lot. There is so much government regulation that nobody has kind of made money. And if you look at the market cap, it's almost 4 lakh crore. And that is almost for Airtel, 1,80,000 crores, equity 60,000 crores, that will be these 3. Whereas when you look at the other players, like Vodafone, their equity is also in negative. That is almost 2 lakh crores. And it's not a good place to be very honest, right? So again, not very great industries to be part of. And if you look at MTNL, Tata Tel, all these have negative equities, right? They are all having very huge debts. So again, not the best of the investments to be in. I will just show you a chart of Reliance Communications. So you see, just before, I think this is 2006 or 8, it was almost 800 rupees. And now it is the 99% of the wealth has actually gone from this, right? So now it is available at 3 rupees. So you see the wealth destruction that happens when these companies go bust. It's massive. So you have to be very wary of companies that have high debt, very regulated, or have very high capex. You have to be very wary of these businesses. The second thing I want to talk about, what makes a company great, is simple business model. Okay, so what I say is, first, there should be a business model. Okay, many companies don't have a business model only. Every 2-3 years, you will see the business model changes, right? So first, there should be a business model.
And secondly, if I cannot explain the business model in 5 lines or less, I won't enter that business. So sometimes you don't want to do or get into too complicated of a stock, right? And one example I can give here is Reliance Industries. So if you look at Reliance Industries, it's in all of these things, right? So it is in retail, it is in electronics, it is in e-commerce. Oil and gas is the main business. They are in media, they are in healthcare. So many things they are doing, right? So for me as an investor, if I have to really understand and research this business, it becomes very difficult for me to understand this business. And even if I understand this business, if 2 segments are doing well and 3 segments are not doing well, how do I take a view on the entire business, right? So then the complexity kind of increases. And if you look at the numbers also, a company that is a conglomerate in India, generally all conglomerates in India, be it Mahindras or be it the Tatas, if you look from a parent level view, they don't make ROE. So even if you look at Reliance, the 10-year ROE is only 11%, and they have never kind of crossed 11%. So that is the maximum ROE that they will give you, right? In absolute terms, they will make a lot of money. For the promoters, it's very good. They in absolute terms, they make a lot of money. But for us small investors, it really doesn't make sense. There are better things to buy out there. Compounded sales growth, again, it's not that great. Compounded profit is not that great. Yeah, the stock price has kind of done decently well, right? Okay, then the third thing that we want in that company is competitive advantages or moats, right? So what are the types of, or what is a moat, so to say? So basically you have this castle, and around that castle you have this body of water. Okay, this is called a moat typically, right? And in business also there is something called as an economic moat or an economic advantage. And Warren Buffett says that if your competitors know your secret and still can't copy it, that's a structural advantage, that's a moat. Now, how can this be that a company does something everybody knows and still people cannot copy it? How can people not copy it? So let's look at some types of moats and why it is so difficult to copy these moats, right? And the first moat we see is the brand, right? And if you look at Coca-Cola, it serves almost 190 crore drinks every day, and it is served in 200 countries. Okay, and it has got this brand name around it, quality, taste, and all these things. And it's very difficult for any new guy to kind of come and disrupt their business, right? The second company that we look at is HDFC Bank. Now, HDFC Bank has the culture of, as the moat, their moat is their culture basically, right? So it is the largest private bank in India. It is the 10th largest private bank in the world. It has got a solid culture, and you can only imagine that how good the culture is, that in Kingfisher Airlines, almost every major bank in India had an exposure, but HDFC Bank did not have an exposure because they said we don't want to give loan to a business like that, right? So culture is their advantage. Now there are so many banks, PSU banks, who know what HDFC is doing but still can't copy it, because now that culture is very difficult to change. You know, there are these hundreds and thousands of employees. How do you change their mindset and their culture? It's extremely difficult, and HDFC has done that extremely well over the years, and that is why it gives the numbers that it gives. The third mode, the third company that I want to talk about is Nike, and Nike does almost $45 billion in revenue, and it sells almost 80 crore shoes every year, right? And if you all are interested, you all can read a book called Shoe Dog. It's written by the promoter of this company. It's an excellent book, and he talks about his journey and how he created Nike, right? And very difficult. These brands are so well entrenched within the customers and the kind of things that they do. It's very difficult to kind of disrupt them. Then you have a company called GSK, right? And these are basically companies which do a lot of R&D, and they invent newer and newer drugs. And when they invent a new drug, they get a 20-year patent on that drug, right? And GSK spends $5 billion every year on research, and they have almost 40 medicines and 17 vaccines that are under development right now. So you can only imagine a company that does $34 billion in revenue and $9 billion in profits, spending almost $5 billion in research, right? So that's a big amount of money, and nobody can kind of do what they are doing without spending that kind of money, right? Then there is Apple, and Apple does almost $365 billion of revenue, and they do $24 billion only in wearables. Okay, that is your Apple Watch and your Apple earbuds. And if you put that in a separate company, okay, it would be a Fortune 500 company. So just imagine a company creates a new division, and that division within 3 or 4 or 5 years is a Fortune 500 company. It's amazing. Then you have Apple, you have Google, and the interesting thing about Google is, if you think, none of their products are chargeable to the customer. All their products are free to the customer, the end customer. Be it Google search, be it YouTube, be it Android, be it Chrome, anything. It's all free, right? And they charge from advertisers. Okay, they sell or they monetize from the data that the customer gives them, but the customer doesn't pay anything. Now, a company who doesn't charge anything from their end user, it's very difficult to kind of disrupt that kind of a business, right? And if I talk about one of their purchases was YouTube. They bought YouTube in 2006 for $1.6 billion, and today YouTube does almost $20 billion in revenue, and they have almost 230 crore subscribers, and they have 3 crore premium subscribers. So they are now starting that premium service, and already they have got 3 crore people using that service. So it's phenomenal business model, right? Then we talk about the second type of mode, which is high switching costs. So this typically happens in software companies. You know, you have a SAP or an Oracle, and once the company uses that, then it's very difficult to change that, because then if you want to change that, that has a cost, and then you have to retrain your employees and things like that. So that is one of the modes. Then this third mode is monopolies by law. Then there are these monopolies that are created. So best example I can give you is Indian Railways or IRCTC. They are the sole sellers of ticket or e-ticketing in India. Then you have a company like GAIL, which does this gas pipeline and distribution sort of businesses. So these businesses have monopolies. They are good, but the problem is that they are for the public good. So government can change regulations too quickly for the benefit of the general public. So then that is a very big risk associated with these sort of companies, right? Then the fourth is network effects. So you have a network and everybody uses that network, and basically it's very difficult to create that network. And once everybody is on that network, it becomes again very difficult for other players to break you away from that network. So you have examples like Uber, Facebook, WhatsApp. I think WhatsApp is a very good example. There are so many messengers that came, but nobody kind of made any dent on WhatsApp. And the last mode that a company can have is that it can be the lowest cost producer. Now, what do I mean by the lowest cost producer? So there are these companies like Bima does business, okay, that nobody can kind of match the prices that it offers. Similarly, then you have a company called DVs. Now, DVs again, it manufactures your APIs for other MNC businesses, and the cost at which that they manufacture these drugs is phenomenal. I mean, nobody can beat them. They are so good at it. Similarly, you have a company like Hindustan Zinc, which is amongst the lowest zinc producers in the world. And if you look at their balance sheet or their P&L, almost 50% of what they make in revenue is profit. Super, great businesses again. So there is a difference between brand and commodity. Okay, so what is a brand based or an economic franchise business and a commodity business? And let's understand this. So a brand based business has near inelastic demand. It has the ability to increase prices. It doesn't require large capital. It has low regulatory interface, offers tangible benefits to its customers who can differentiate offerings through its brands, and it is mostly consumer facing, right? And on the other hand, if you look at commodity businesses, they have little pricing power, they have little differentiation, they have high capital intensity. Okay, basically they compete on pricing. It's only good if it's the lowest cost producer, and it mostly supplies to other businesses. So the best example I can give you here, commodity business, cement business. Okay, so if you look at cement, it's a commodity. Nobody, if you're a builder, you don't care about the the brand. The only thing you care about is that it should be cement. Okay. And basically anybody who will give you that for the cheapest price, you will buy from him, right? And within cement, the lowest cost producer will be the person who is regionally present there. So any factory that is there in a particular area will be the lowest cost producer in that area. So even in cement, if you see, regional players will only supply in that region, and then there is nobody else who can sell in that market, right? So this is what we've seen. So mostly they supply to business. So it's a B2B sort of a business. It's not a B2C business, right? All commodity businesses generally are B2B things. So best example in that, within that also is Infosys. So Infosys, basically what they are doing is, any American company who wants to get a software made or coding done, they can outsource it to an Indian company, where we have these Indian software engineers who are paid much lesser than what their American counterparts are paid, and then that same job can be done for a fraction of the cost, and then you take benefit of that. So what makes and even in the previous example, you look at companies like Nestle or Asian Paints, the brand is so well entrenched. Even if a company like Pidilite, which makes Fevicol, I mean, painters and furniture people, carpenters, they swear by it. If I tell my painter nahi Asian Paints ne hum dusra lagate, so they will like nahi Asian Paints hi lagana. They are so hell bent on it, and I've seen this so many times. They don't want to use any other paint. Even with a carpenter, if you tell him I give you any other Fevicol, they will say no, I only want Fevicol, right? So that's how well entrenched the brands actually are. Then the second last point is great management team. So management is extremely important in any business, right? So what are the characteristics that make great management? So first is that they should be honest, they should have unquestionable integrity, they should be focused, they should be unemotional, they should have exceptional firefighting skills, like what we saw again in the case of Nestle. The Maggi crisis that happened, I think they destroyed 150 crores worth of Maggi in a single day. And then they really, on the PR front, they did an extremely good job. And then Maggi survived, they got new flavors, they again came back much stronger, and today Maggi again is the market leader. So you need management who has exceptional firefighting skills. Then you need intelligent fanatics who can come and who can actually turn around the business. So one example I can give you here is Jubilant Foodworks, the Domino's guys, and the company was not doing so well, and they got a guy called Pratik Pota from Pepsi, okay, and he really did an amazing job at turning around the company. So he did amazing job campaign, ad campaigns. He actually changed the product and things like that, and he really got the company back to its former glory. And I think he resigned only a few days back, and the stock, I think, tanked almost 10-15%. Right. So you need people who are intelligent to run the business. And the last point is that they should have exceptional capital allocation skills. Right. So they should be able to. So if you look at Kingfisher and the way Vijay Mallya, the successes in the alcohol business, and whenever he went to do any other business, say in the airlines business, he did not get that success, right? And personally, he lost a lot of wealth doing that. Similarly, what acquisitions these promoters are doing, at what price the buybacks are happening, how are they with the dividend policy? If the company is doing extremely well, or if the company has got debt, and if the management is paying out dividends, then that's not a right thing to do. Then the company should not pay the dividends; they should pay out the loans. And probably they should keep this money and reinvest within the business. Then there is no need for me to get that dividend, right? So all these things also matter a lot as far as the management is concerned. And great managements make great companies, right? And one example I can give here is the Lloyd Havells merger that happened. So there was a company called Lloyd's, and they sold their AC brand to Havells for 1,600 crore rupees. And at that time we were following this company, and we said, chalo, this is a special situation, and we said, let's invest some amount of money here and see what is actually happening, with the company. And we purchased a small stake in 2017. At this price, we entered at almost 235 rupees, and then we sold at 275, and today the stock is almost 2 rupees and 60 paisa, right? So from a market cap almost 900 or 1,000 crore the market cap is now only 10 crores. Now, what happened in this company? So this company had promoter fraud, right? And whatever money they got from the Lloyd sales, all this money was diverted to all these sister concerns that were there. And then the management even stopped filing their returns from March 2018, right? So we invested a small amount just to see what happens in a special situation. Then we saw how the management was behaving and things like that. And then we said we don't want this and we sold it off, right? And then the stock kind of corrected. And this was a very big learning for me because I was learning about special situations then, and whatever special situations was coming, I used to invest 1-2 lakh rupees just to see what happens in a special situation, right? And if you look at one of the articles of Money Control, so there is a guy called Porinju Valiant, who's a very successful, runs a very successful PMS, has a lot of clients and a lot of money. And basically, this guy, he had almost 8% equity in that company. So whatever PMS he runs, 8% of this company he was owning in that PMS. And this article says Leel Electrical is a company that gave its investors and Porinju lots of losses and learnings. So Leel sold its consumer business for 1,600 crores. Fund diversion and operational hiccups led to significant erosion in the stock price. And investors should never compromise on management quality, and accounting policies are a reflection of promoter intentions. So this is again very important that we have to be wary of all these businesses, and bad managements can really put you in the hole, very deep into the hole, right? And the last point is that you should be able to mitigate the risks that are there in the business. Now, how do you mitigate these risks? So first is to diversify the portfolio. So I'm not saying that you should have 20 or 30 or 50, but at least have 7 to 10 portfolios in your 7 to 10 stocks in your portfolio. Diversify the portfolio. Number 2 is buy great companies in great industries that we have spoken about. Buy only when the management is honest, capable, and good capital allocator. And don't overpay. Buy at fair valuations. And keep on assessing business risks and have the ability to exit the moment risk seems unmanageable or too extreme. So I think this is a very continuous process we do with all of our investments. So every quarter we will sit, we will understand what has changed. Is there any risks that have cropped up? And if you do this on a regular basis, whenever risk is going to come, you will get the indication of that risk. And when you know that risk has mitigated or risk cannot be mitigated or risk has materialized, then even if you are incurring losses, just exit from that business. Don't hold on to those businesses. Now let us talk a little bit about valuations and what fair valuation is, right? So say if you have a box, okay, and if this box is going to give you certain money, so say if this box is going to throw out 100 rupee note every year, say on 31st December, okay, and it is going to do so for 10 years. So in the 10 years, you will get 1,000 rupees. And then at the end of the 10 years, this box will open and then you can use it as a jewelry box. And the value of that box is say 100 rupees when you go to buy it after 10 years. So in effect, in this transaction, when I give you such a box, you will get 1,100 rupees in that transaction, right? Now, how do you value this box, or how much will you pay me for this box? So simply put, I can give you this box for free. So the value of this box can be 0. I can be generous enough and give this to you for free. So the value can be 0 rupees. Or you can be generous and you can give me 1,100 rupees for this box, right? And you recover that money over 10-year period, right? So we can safely say that the value of this box is anywhere between 0 and 1,100 rupees, right? Now, how much do you pay for the box is a function of how much return you want to basically make, right? So if say somebody wants to make a return of 200 rupees or 50%, then he will pay 200 rupees for this box. If somebody wants to make say 22% return, then he will pay 400 rupees for the box, so on and so forth. And if you pay 1,100 rupees, then you will get 0 returns. And sometimes in equity, we have seen people will even pay more. They don't understand what the value of the business is, and they will even pay 2,100 rupees for that box, and they will make a 10% loss every year, right? So this same thing can be done for your equity investments also. So what we typically do is say we have a company, say Asian Paints, if we are valuing, then we know that what Asian Paint sells every year, or what Asian Paint sales are there every year. So if say Asian Paints does 27 or 30,000 crores of sales every year, okay, we know that next year it will do 33,000 crores, next year it will do 37,000 crores. So we get the sales, and basis on that sales, we can take out the net profit, whatever reinvestments need to happen in that business, whatever working capital investments need to happen in that business, and basis that we can safely remove a cash flow that the business is going to give me every year, right? Then at the end of 10 years, I will give the terminal value to the business, and then everything I will discount to whatever return expectation I'm having. So somebody will give a 12%, somebody will give 15%, somebody will want 5%. So basis that they will determine the price of Asian Paints, right? And they will pay so much money for that stock, right? So the same thing can be done for any asset. If you know the cash flow of the asset over a period of time, you can kind of remove the fair value or the intrinsic value of the business, right? And I'm not saying that intrinsic value is the only way to basically value a business, but there are other ways to value a business also. But what intrinsic value does, it gives you a benchmark as to what the businesses are going to do and what kind of returns you can expect from that business. And then you have other values such as price to book. Basically, when you are valuing any financial stock or a banking stock, then you use the price to book multiple. Then if you are buying some FMCG sort of a business, then intrinsic value will never justify the price that you're paying. So there, in that case, you want to buy basis price to sales. Then you may even buy some companies based on price to earnings. Sometimes if you know that this company, the price to earnings is so much, then you may buy it at that price also. So again, I'm saying that valuation of a company is an art. Okay, it is not a science. It takes a lot of experience. It takes a lot of practice. And sometimes as investors, when you keep doing this, you know that when a company is cheap and you know when a company is expensive. And basis the coming to the price, if you look at the Titan chart from 2009, if you look from this period onwards, what you see these blue lines is basically the periods in which the stock has corrected for more than 20%. Okay, so I call this a barcode chart. Okay, it looks like a barcode. Okay, and from 2009, there are at least a dozen instances when the stock has corrected for more than 20%, right? And when your stock is actually correcting so much, it's very difficult to hold on to the stock in these kind of volatile times. And that is when your research and your conviction in the business, as well as the price that you have purchased that business for, it makes a very big impact on your self confidence to hold this stock during these volatile times, right? So if you take any company in India or any company in the world, it will almost be like this. It will be like a barcode only. These blue phases will be there in the stock, where the stock prices will keep correcting over a period of time. So the lesson that we learn from this is have an investment philosophy. First rule is don't lose money, and second rule is never forget rule number 1. Buying at fair valuations will help you brave occasional drawdowns, and people have different risk and reward appetite. Don't copy others. So if some FII is buying or if some big investor is buying, they may have a different risk and reward appetite. So don't just blindly copy others. You think for yourself what is your return expectation and what price you are comfortable at buying something. Okay, then what vested interest of various organizations will not tell you about investing. And this is basically, I have spoken from the point of view of your broker, of your PMS, of your mutual fund, and what they will honestly not tell you. And if they were supposed to tell you something honestly, how will it sound basically, right? So a broker will say that long-term investing is boring. We love short-term trades. More trades generate more commission, right? To be very honest with you. Okay, then our report recommendations need to be taken with a pinch of salt. We can justify anything by throwing a lot of technical mumbo jumbo that you will easily fall for, right? So you have these research reports wherein they are talking about the same company, and one company will say that it will go up 50%, and one company will say that it will go down 50%. And you read both the reports, and both of the people have very well justified their point of views. So again, one has to be very wary of these research reports. We may tell you to keep holding on to a bad stock just because we don't want to admit we were wrong. This has happened multiple times in the past with so many big names also. Sometimes we may good stock that is going to go up in value just so that we can generate some extra commission. So when they feel that, okay, a lot of people in their portfolio are holding a particular stock and they want to create some commission or brokerage, then they will tell everybody to sell that stock. Remember that they are not qualified or legally right in doing so. So you have a dealer you call every day or who calls you every day, and he will give you all the investment gyan he knows in the world. But just remember that basically those people are not qualified and they are actually doing an illegal thing by giving you investment advice. They cannot give you investment advice. And yet so many people fall for these dealers, and these dealers will tell them some things and then they will blindly go and buy these things. So be wary of all these things.
Sahil, your voice is not. Are you on mute?
Hello,
This is audible.
audible? Yeah.
Yes.
So did you all miss a lot?
No, just start from this slide.
Okay. So what your mutual fund will not tell you, your mutual fund will not tell you, our aim is not to beat the benchmark index. All we care about is to do better than competition. That is what keeps us relevant, right? So their aim is really not to beat the index. They just want to be better than every other mutual fund. So if every other mutual fund is making 10%, if they make 10 or 11 or 12%, then that is what they want to do. They don't want to make you 15 and 20% returns, right? Then of the 289 actively managed equity-based schemes, only 34 schemes beat the benchmark index by more than 200 basis points in the last 5 years. That is just 12%, right? The primary reason for such poor performance is excessive dilution. Very few funds will have less than 25 stocks in their portfolio. Most will have more than 50. So you can only imagine if your Nifty has 50 stocks or your Sensex has 30 stocks, and if a fund manager has 50 or 60 stocks in his portfolio, okay, then how is it possible for him to actually beat the benchmark? If you are so diluted, it's not going to work for you. So you have to be concentrated, not very concentrated as to 2 or 3 stocks, but at least have 7 or 10 stocks, nothing more than that. If you're too diluted, you will not make money. Investing in a low cost passive index fund will be better than investing in 88% of expensive actively managed funds. And buying at any price is fatal even to mutual fund investors. Only exception is SIP through thick and thin, right? So people feel that mutual fund we can invest anytime, any price, but that also can be fatal to your returns. If the markets are too expensive, and if you're buying a particular mutual fund, it can lead to losses. And obviously, the only exception to this is SIP, because SIP covers everything. It covers the tops also and it covers the bottoms also. So if you're doing an SIP, then you should be safe. Then your PMS or your investment advisor. So we have 2 sets of returns. One is our model portfolio returns and the other is your actual portfolio returns. We never talk about the latter, right? So what happens is that these fund managers, they have built their portfolio over a period of time, slowly, right? And they have only invested when the prices are right. But then they convert this into a model portfolio, and then whoever comes in the fund, they will just buy whatever is there in the model portfolio at that point in time. So the returns, what you make and what they show would actually be very different. The difference in return is due to timing. Our model portfolio is built gradually over time and stocks are bought when they are fairly valued. However, purchases in client portfolios are done at ad hoc valuations. And there are times when we know the model portfolio is too expensive. At such times, our clients should sit on cash and wait for prices to become favorable. But we don't tell this to our clients. Instead, we just focus on our fees and AUM growth. And some of us engage in what's called a pump and dump strategy. So they will buy a particular stock, they will then increase the price, sell it to their clients, and then they will exit. And then everybody is left holding a stupid stock in their head. And some of us also don't have skin in the game. And some of these people, what we've seen is that they will buy something for themselves and then they will recommend something to others, right? So they don't have skin in the game. They are not doing exactly what they are preaching. So the conclusion here is buyer beware, right? One has to beware. Okay, the sixth lesson is why behavioral finance is the most critical factor in investment success, right? And what makes a great investor great? So the first point is the ability to focus and cut out noise. So there is a lot of new ideas that keep coming, Bitcoin investing, this, that. So one has to kind of focus on what one is doing, on one's investment philosophy, and cut out all of this noise. I'm not saying that one should not understand these new phenomena, but once they understand it, they should rationally think about it and say, okay, this is not for me, even if other people are making a lot of money doing that. Second point is ability to sit on cash, right? So many people I see, they don't have the ability to sit on cash. When they have money, they just want to invest the very next moment. But a great investor has the ability to sit on cash, wait for market to come down, and then slowly invest. Then they should have the ability to suffer, because stock investing is not easy. You will buy something, it will go down in price, it will go up in price, then again it will go down in price. You should have the ability to suffer. You should have the ability to sit through those times of volatility. Then you should have the ability to go against the tide. So there are times like Corona when everybody is so negative about the market, and if you feel that no, markets will recover in 2 years' time, and if you can invest in those periods, then you are actually going against the tide. And if you have the ability to do that, then you can become a great investor. And then Charlie Munger says something about sitting on cash. So he says it takes character to sit with all that cash and do nothing. I didn't get to where I am by going after mediocre opportunities. Right? So the last thing that I want to talk about is there is this match that happened on 2nd of April 2011, and India won the World Cup, right? And I, with my friend, we went and saw this match in the stadium. It was an amazing day, and the whole day was so high energy. But there is one moment from that match which really stuck with me, and this was actually the moment when Dhoni hit that ball out for a 6. And the fascinating thing about this moment is that there were 11 balls that were left to be bowled. 11 balls we had to bowl. We had to play, and we just needed 4 runs. Okay, so Dhoni had no reason to take so much risk. Okay, and hit it out for a 6, right? So why did Dhoni, or how could Dhoni hit that out for a 6? Okay, and there are 3 factors at play here. Okay, the first factor basically is his skill as a good batsman, his years of practice and experience. Second is Dhoni's psychology, okay, his fearless attitude, okay. And the third thing is basically instinct, right? And when I talk about instinct, basically in that moment, he doesn't have a lot of time to think, okay, and he just knows that this is the ball, and if I hit it like this, it will go for a 6, and he doesn't have time to think and process, and he just hits it for a 6. And even in investing, or a seasoned investor, sometimes you need that instinct. If you don't have that instinct, sometimes you like something, you have read about it, and it becomes, there is some problem, and you know that okay, this is good, but this is going down in price unfairly, this is unreasonably low price, and I need to buy, I need to execute. You need that instinct to actually stick your neck out and buy at that point in time. If you don't have that instinct, then you will not be able to execute. You will just keep thinking all this while. And that is also what makes investing difficult. People should have that instinct. If you don't have that instinct, then it becomes very difficult. Then you will just keep thinking and you will not be able to execute. And lastly, the last lesson that I want to give today is money will buy you freedom, but it will not buy you happiness. So money is equal to freedom. So whatever wealth we create for ourselves, first of all, it gives you the freedom of time. So if you have enough money and if you're not happy with your job, then you can actually leave that job and go to some other job or do your own thing. Then it gives you freedom from ill health. If you have money, you can get the best of the treatment if you have some untowardly medical condition. And third is that it gives you freedom from discomfort. You can buy a nice car, you can buy a nice AC, you can buy a nice house. So whatever discomforts are there in life, money kind of gives you freedom from all those discomforts. And the last is it gives you freedom from dependence, right? So you're not dependent on anybody, you are independent, you can do your own thing, you can do as you wish, right? And there are two books on investing which I would recommend everybody to read, and one is called Rich Dad Poor Dad, and the other is The Psychology of Money by Morgan Housel. These two books are a must to read. In fact, I tell my kids that I have two kids, they are very young, but I have decided that when they turn 18, if they don't read these two books, then I'm not going to give them pocket money, right? So these are extremely, extremely important books that one can read on personal finance and fundamental investing. And the second point that I want to highlight is that money does not bring happiness, okay? And what most people fail to understand with money is that there is a problem with the reference point. So if you look at this chart, the circle on the left looks smaller, the orange circle on the left, and the orange circle on the right seems to look bigger, but actually they are both the same size. Now the problem is actually with the reference points, and what we generally do is we look at people who are above us and we don't look at people who are below us. If you look at people who are below you, then you will automatically feel good and you will feel happy and you will be happy all the time. And the other problem which I have seen now is that there is a lot of instant gratification that we want. We want to watch TikTok and Instagram and we just want to consume everything fast. Nobody wants to invest time learning about philosophy or history or spirituality. And if you think of our lives 100 years back, what kings used to live, we have better lives than kings, right? So if I talk about my mom, when my mom was young in 1960s, my mom said that sugar was a luxury for her and her family. Right? She comes from a very small town in Gujarat, but she says sugar was a luxury. Okay, you can only imagine a person say 50 or 100 years back, if you would have get cataract in his eye, they would actually practically become blind, right? Old people would become blind, and today it's just a 15-minute procedure which costs less than $100 to get done, right? So phenomenal advancements in that area. If you look at information and data, the data that I've shown in some of these slides has 50, 70 years of data, and I can take that data at a click of a button and I can put it on a graph in 10 minutes. And if I have to do this manually, I think I'll never be able to do it even in a month's time, right? So much advancements have happened. There is so much to feel happy about. So I think one should always be happy. One should always look at people who are below them and not above them. And one should invest in experiences and not things. So always try and invest in experiences, go travel the world, meet people, have good food, build experiences, build memories, rather than just buying 5 and 10 pairs of shoes and 50 pairs of clothes and buying just expensive cars and things like that, right? So buy experiences. And so there is a quote by Prophet Muhammad, and he says, look at those who have less than you and do not look at those who have more. Least you should belittle the blessings of Allah that you already possess. So very meaningful quote. Okay, now talking a little bit about the Ukraine-Russia war. We can stretch this for 10-15 minutes more. Is it possible, Warren bhai? Hello. Hello.
Gaurang?
Ashish bhai, can we stretch this a little bit more?
Yeah, not an issue. If we
Not an
can
issue, right?
complete it in 5-10 minutes, it would be great.
It will take a little longer than then, or I skip this. Chalo, we'll try and finish in.
You can summarize if possible, Sahil ji.
Yeah. Chalo, okay.
Yeah.
Okay, so we know how the war has played out till now. That's okay. But I just want to highlight on a few things here. So since 1941, the S&P 500 has averaged a total drawdown of 5% following 21 major geopolitical events, including the Pearl Harbor attack, the assassination of President Kennedy, and the September 11 terrorist attacks. Despite the initial market volatility, S&P 500 has subsequently taken an average of only 45 days to fully recover from those initial losses, right? So if you look at all of these, the maximum time was Pearl Harbor, wherein it took almost 307 days to recover. But if you look at any other event, the recovery has been pretty fast, right? So what are the impacts of this war on the economy? So short-term volatility in stock markets is going to be there. NATO, we know, will not engage. And inflation in energy and food, we are already seeing. And obviously, this will slow down the COVID recovery. Interest rates hike will follow to control the inflation, and this will lead to a fall in asset prices, including your stocks. And this again, I feel, is transitionary and will not impact the long-term equity shareholders, right? So, in summary of this entire presentation that we did, okay, so the action points that I want you all to do once you all go back. First is find out your personal asset allocation. How is your personal asset allocation? How much of your patient's capital is invested where? Do that exercise. Second is calculate and compare your CAGR with the benchmark. Even if you are owning a property or if you are owning any other asset, just see how much CAGR you have made on that particular asset. Okay. And the third is get your equity portfolio reviewed. So if you are a person who invests in equity, and if you are kind of lost somewhere that you don't know what you're doing, then you should go to a professional and get your equity portfolio reviewed and understand what is wrong or right with your portfolio, right? And I'll just talk a little bit about what I do and what my company does. So we are a registered investment advisor by the name of Mount Bliss Capital. So my personal returns since 2015 are 27%, and for the clients that I'm managing since 2020, since the last 2 years, we have done a return of almost 37%. Okay, you all can go to my website, mountbliss.co.in. You will find more information here. You will find information about our pricing and things like that. And what we are doing, just to highlight or just to summarize what we actually can offer you, is first of all, we are a shared family office. We do extensive research. We are very focused. We are the lowest fees in the industry. We have a concentrated portfolio. We have our own skin in the game. So whatever we advise our clients, the very same thing we are also buying in our personal portfolio. We have the ability to sit on cash. There is no entry or exit load, and the assets are there in your name. And we have tailor-made portfolios for each of the people. So basically, if somebody is coming to me today, I'll buy certain things. But if somebody comes to me 6 months afterwards, then I'll not buy the same things. Then at that point in time, whatever is cheap, I will buy that. So you get tailor-made portfolios. You don't have a model portfolio kind of an approach. And we also have a client referral scheme that we run. So you refer your clients, they get a discount, and you get a referral fee, right? So anybody who's interested can get in touch with us. You can go to www.mountbliss.co.in, fill up this contact form. I think anybody, if they want my personal details, they can take it from Gaurang Bhai. Okay, and we can take question and answers if there are any.
Thank you so much, Sahil bhai. It was a brilliant session. In detail, you have explained us about the capital markets. I will keep the forum open for a couple of minutes if any members have any queries or any comments.
Okay, I am here on this machine, if that is okay.
Members have initially asked if you can share your presentation.
Okay, I'll share the presentation with every one of you. Sure.
And do show your contact details also. I have your mobile's number, but
So
apart
I
from
can,
that,
can I just type my mobile number here in this chat box?
that is fine. Or I'll share post in our group also.
Okay, fine, no problem. I've shared my mobile number. If anybody wants to get in touch with me, they can just get in touch with me.
So I guess we'll end the session. Thank you so much. On behalf of Andheri West Study Circle, I would like to extend my vote of thanks. Thank you for sharing your valuable time, insights, and knowledge on the capital market. In detail, you have explained the 7 lessons for the investor, starting with explaining us about the different class of assets, their risk, volatility, return, and liquidity of each assets. You have then gave us the insight about the index investing, followed by the ways to beat the index and the importance of CAGR return in our assets. You have explained us in detail about the different investment philosophy, share the philosophy of some of the great investors like Warren Buffett, Bill Ackman, Jim Simons, and others, and gave us the insight about how a family office works and about your own investment philosophy. Post that you have shared and in great detail enlightened us about the main points to look for a great company and great industry to invest, in which we have discussed about the various companies from Titan to Asian Paints to various markets also. At the end, you have, create an awareness like the buyers be aware and understanding the behavioral finance. And ending the session with the impact of current war on the economy as well as on the stock market, and listed out the action plans which one needs to take into actions while investing in making investment decision. So thank you once again on behalf of Andheri West Study Circle, and thanks to all the members and the participants. Thank you all.
Thank you very much. It was a pleasure having you all. Thank you so much.
Thank you, sir.
Thank you, Sahil ji.
Yes, bye.